Welcome to this week's episode of Financially Speaking. As a local family-built firm, Buska Retirement Solutions, along with its affiliate companies Buska Wealth Management and Legacy Tax Solutions, offer one-stop retirement, tax, and legacy planning services to families nearing or already enjoying retirement. Sue Buska is president of Buska Retirement Solutions, a retirement planning company helping develop financial, Medicare, and health insurance strategies. Over a decade ago, she partnered with her son, Cole Bruner. Cole, an investment advisor representative that's held to a fiduciary duty, is president of Buska Wealth Management, a fee-based registered investment advisory firm providing financial planning and investment management for individuals and businesses. Legacy Tax Solutions offers personal and business tax planning and preparation services. Their enrolled agent, Carl Van Setters, is a military veteran with over 10 years of accounting experience and is committed to maximizing your tax credits wherever possible. Over the last several years, Sue and Cole have continued to grow their team of private wealth advisors to meet the increasing demand of retirees seeking guidance. In 2018, Ryan Connor began serving clients at their Eau Claire location. At their Wausau location, Logan Wooler became a part of the team in 2020. And in 2023, Sue's daughter Kaylee Berenson joined the firm. As a family-built firm with offices in Wausau and Eau Claire, their dedicated team of professionals have the experience to provide custom-tailored strategies to help you achieve your long-term financial goals. The next 30 minutes will be filled with retirement information presented by their team in a simple manner that you can understand. So stay tuned because Financially Speaking starts right now.
Why is an emergency fund important, and why is it an important part of the financial strategy?
Today, I want to discuss the different lifestyles you may choose for retirement.
Now, today, Logan and I are going to talk about your retirement plan tax prep checklist.
And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm here with Cole and Kaylee from Buska Retirement Solutions and Buska Wealth Management. We've collected some questions about planning for retirement that we're going to answer today, but if you'd like to see your question answered on a future segment, please email us at info@retirewithbuska.com. Cole, Kaylee, thank you so much for joining me today.
Of course.
We're going to turn our attention to emergency funds. Okay, so Cole, why is an emergency fund important, and why is it an important part of the financial strategy?
Well, I think, surprises can happen at any time. And I think that's the thing that sometimes we don't realize even after we retire. Emergencies can still come up, the furnace can still go, we still have to replace the roof periodically, all that fun stuff that comes with home ownership and everything else, and, car repairs and unexpected things that pop up along the way. And if we don't have funds set aside specifically for those purposes, we might find ourselves dipping into retirement accounts more heavily, which may not be a great idea, relying on high interest credit cards, which is a much more common thing. And especially in the high interest rate environments that we're in today, that could be really costly. I mean, you could be spending upwards of 20% interest on any of those funds. So certainly if we can avoid that by, maybe squirreling away a little bit of money here and there whenever we can to have that emergency fund set aside, it will reduce our reliance on those high interest credit cards and, having to look at ways to produce other withdrawals from retirement accounts and things. We want to try to avoid that at all costs. And obviously emergencies could be at any time. They can surprise us at any point. And if we're unprepared, we might find ourselves having to react to that situation. And obviously we always preach about being as proactive as possible because it makes things more predictable. Obviously you can't plan for every possibility in life, but we can do the best we can to plan against the ones that we know are there. And obviously, emergencies, unexpected expenses, they can happen anytime. So we should absolutely be prepared for that.
Absolutely. And so as we're planning for what we know might be there,
right.
Kaylee, can you talk a little bit about how large should that emergency fund be?
Yeah, sure. So the rule of thumb is 3 to 6 months of monthly expenses is a good, healthy emergency fund to have set aside. That might not be attainable for every household, though, depending on their unique circumstances. So just starting out with what you can save every month is just a good place to start to get that emergency fund building up.
Yeah, I mean, every dollar counts when it comes to that. So, I mean, if you're trying to create an emergency fund, you might think, well, I can only spare $20 a month or whatever it might be. Well, every dollar counts towards reaching that goal. So obviously, if you can put any amount away every month and be diligent about that and put it into an account, maybe that's at a different bank or with a different financial institution that you're not seeing every day, that can really be helpful because it's kind of that set it and forget it type of mentality. If we don't see it every day, we might not realize it's there. And so we may be able to it may be easier to avoid that temptation to dip into those when we want to, go buy some new clothes or take a trip or whatever it might be. We wouldn't consider that an emergency expense, obviously, and we should try to avoid those unnecessary expenditures until we've reached that goal of hitting that benchmark of having that emergency fund set aside.
That's great. And you gave us one good tip, but what are some other good ways to add to an emergency fund and get started?
I think starting where you can is the most important piece of advice we can provide in that particular topic, because everybody's financial situation looks a little different. Everybody has a different amount of potential expendable income from month to month. So I would say start by looking at your budget. Start by looking at what's coming in every month, what has to go out, what your built-in obligations are, mortgage, utilities, insurance, taxes, all those types of things. But then once you've determined what that remainder is, you can determine what percentage of that remainder you can comfortably dedicate towards building that emergency fund. And then, of course, it might take you a little time, but chipping away at that over the course of time is definitely a better plan than just, throwing our hands in the air and saying, well, I can't do it because I don't have the ability to save money every month. There's got to be some sort of strategy that we can implement. And sometimes that's working with a financial professional to figure out what that looks like, running through the budget together, trying to figure out where we can squeak out a little bit of additional income to be able to set that aside for that possible, emergency or unexpected expense in the future.
Absolutely.
And I think reviewing your budget regularly also makes sense, just because what if you have a debt that gets paid off or you get a raise at work? Yeah. So maybe then you can up your contributions a little bit.
Yeah, and also, in today's world, we have so many subscriptions, and we see this all the time, even in my own life. I've looked at my list of subscriptions, like I haven't used that in months. What am I still paying $15 a month for that for?
Because you set it and forget it.
Exactly.
That happens, yes.
It can happen, and even if we're the most diligent budgeters and things like that, sometimes those things slip our mind and we don't realize the importance that has. $15 a month over the course of a year becomes a much larger dollar amount. You're talking almost $200 a year. That's money that could be dedicated towards that emergency fund if we didn't have that subscription that we're not necessarily using, and they can become plentiful. Nowadays you could have as many as 10, 15 different streaming services all at the same time. And if you're not actively using them all, is that really the best use of our funds? So like Kaylee said, reviewing that budget regularly, taking a step back and kind of taking a look at what's going out on a monthly basis, check the credit card statement, go into your phone and check the subscription, all that kind of stuff, because it really helps to bring clarity to, are any of these expenses things that I could do away with so I can restructure where those funds are going on a monthly basis in the future.
Yeah, that's great. And what kind of expenses should someone expect those emergency funds to be able to cover?
Yeah, so for an emergency fund, it's meant exactly for that, for emergencies that arise. So that could be anything like unplanned medical bills or auto or home repairs that arise that we just weren't expecting either, like, the furnace breaks down in the middle of the winter. And then also maybe we lose our employment. So things that we need to survive, we should be using our emergency fund for. We shouldn't be confused though for the things that we want.
Right.
So maybe we want to take that vacation this year, or we want to go see our favorite artist in concert, or maybe even overspending on birthday gifts and Christmas gifts. If that's the case, then maybe we open up a different account and we have our fun money account instead of dipping into our emergency funds for those things that we want.
Yeah, absolutely. A lot of people will benefit from having different accounts that they have dedicated to specific purposes, and that can really empower us to make sure that we're being diligent. You might be able to set up auto transfers from your bank or even from your paycheck, where a part of your paycheck goes directly into a side account that's not used for anything but emergencies or travel or whatever it might be. So whatever your goals are, if that's, build an emergency fund, start that vacation fund that we've been hoping for, whatever it might be, save for that new car, whatever, just make sure that you're being diligent about it and you're building it into your budget. It's going to be much easier to stick to that obligation if you've built it into your normal budget and it's just part of everyday life now.
That's great. Well, let's get started on my emergency fund. But thank you both for joining me today. And thank you for joining Financially Speaking. We'll be back with more right after this.
Close your eyes and picture retirement for a moment. What does your dream look like? Would your days be filled spending time with family and friends? Maybe you desire to volunteer or work a rewarding part-time job. Or do you envision traveling the world? Whatever your dream consists of, Buska Retirement Solutions can help you realize it. Call or go online to schedule a complimentary consultation today.
Are you ready to make your retirement planning more stress-free? I'm Cole Bruner from Buska Retirement Solutions, Buska Wealth Management, and Legacy Tax Solutions. Between our three companies, there's a lot we can do to make securing your future easier. By creating a comprehensive retirement plan that incorporates retirement income solutions, investment management, estate planning, tax strategies, as well as health insurance and Medicare planning, you can retire with more confidence and peace of mind. Call us today or go online to schedule your complimentary review.
And now, our Financially Speaking weekly topic segment.
Welcome back to Financially Speaking. I'm Ryan Connor from Buska Retirement Solutions and Buska Wealth Management. Today, I want to discuss the different lifestyles you may choose for retirement. And we all spend decades working and saving towards the far-off retirement of our dreams. And while we may have ideas about what we want to do, have you ever thought about what your actual retirement lifestyle will be? U.S. News and World Report published an article titled 10 Retirement Lifestyles Worth Trying. Now, if you haven't thought about this, you may want to, and in this episode, I'll go over a few examples. The first tip the U.S. News article offers is both very simple and very profound. Reinvent yourself. Consider the years of dedication you put into your career, the sacrifices that you made to become successful. Remember, retirement is your time. If you want to slow down and relax, go for it. If you want to dive right into a new strenuous activity, have at it. There's just one rule, as any financial service professional worth their salt will remind you. Your lifestyle is going to be affected by how much you have saved and what income you're still bringing in during retirement. Thinking about a beach lifestyle? You're not alone. Soft, sandy beaches and warm ocean breezes can lure many of us. Of course, it's no secret that ocean views can be a bit expensive, but a retirement strategy can make life on the beach attainable. Affordable beachfront living is available here in the United States, as well as appealing places across the globe. Try doing some research in the years leading up to your retirement so you'll have an idea of where to look for that dream property. If you've been looking forward to spending your retirement playing golf, you're hardly alone there either. Golf may be particularly beneficial because it also provides plenty of exercise as well as social engagement, two critical components of a healthy retirement. But as any golfer knows, it can be a quite expensive hobby. Thankfully, many warm weather communities have plenty of affordable golf options. Going back to school is often cited as a frequent retirement adventure. Living in a college town that has plenty of arts and culture benefits, but many colleges and universities also offer free or discounted classes for seniors. In fact, going back to school has become so popular with retirees that some colleges have built their own retirement communities very close to their campuses. If you're one of those folks who is eager to keep busy by volunteering during retirement, your options are nearly endless. You can be a mentor, tutor, coach, or teacher at a library, museum, park, or school. It's almost certain that you have experiences and skills that other people could benefit from. Some people want to work part-time in retirement, often not because they have to, but because they want to. Working part-time or seasonally at a museum, concert venue, theater, or even the neighborhood coffee shop can get you up on your feet doing something fun. Remember, with a solid retirement strategies, you call all the shots. You could very well decide to work a little bit for the first several years of retirement before reaching a point where you don't want to do it anymore. And that's okay, because it's your retirement. Now, you may not think that retirement would be a good time to start a business, but older people leaving the workforce often bring a wealth of experience and insight into their new ventures. Becoming self-employed gives you more control over your time, and once you get the business up and running, you can decide how much of your time you need to spend on it. Now, if you're a dreamer, retirement may be a good time to pursue your long-held passions, such as writing, painting, or playing music. It's never too late to learn something new. So why not put all of your newfound free time towards something you enjoy? Gardening can be a wonderful option for retirees. It gets you outside in the fresh air and allows you to spend your days doing something healthy and productive. Plus, you can grow your own fruits and vegetables, which can help you supplement the groceries you buy and maybe even help you save a buck or two. If you cultivate flower beds, your neighbors may appreciate your effort to beautify your space. An article in Greater Good Health titled "The Benefits of Gardening for Senior Physical and Mental Health" also says that gardening helps seniors socialize, which is extremely important in retirement. The whole world is out there waiting for you in retirement. How will you spend it? What kind of lifestyle do you want to have? There's no time like the present to start thinking about it. If you'd like to talk about your financial strategy or retirement planning, contact our office today at retirewithbuska.com or give us a call at 715-355-4445. We'll be right back with more Financially Speaking after this.
Have you heard the term fiduciary before? According to Investopedia.com, being a fiduciary means being legally bound to put your client's best interest ahead of your own. Did you know that investment advisors have a fiduciary duty to clients, but broker-dealers just have to meet the less stringent suitability standard, which doesn't require putting their client's best interest ahead of their own? At Buska Wealth Management, all of our advisors are fiduciaries to provide our clients more peace of mind. Call us today or go online to schedule your complimentary review. Taxes can play a significant role in retirement. After all, they determine how much of your hard-earned savings you get to keep and how much you send to the IRS. But if you're like many savers, you probably don't know the total taxes that you could end up paying. At Buska Retirement Solutions, we believe information is critical to making informed decisions. So I want to share with you a resource that can help quickly evaluate your potential taxes in retirement. Visit BuskaRetirementTaxBill.com to generate your personalized report. And once you've seen your retirement tax bill, let's talk, because there may be ways to improve those numbers.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Cole Bruner from Buska Wealth Management and Buska Retirement Solutions. And joining me today is Logan Waller. Now today, Logan and I are going to talk about your retirement plan tax prep checklist.
You may be wondering why we're talking about a tax prep checklist now. It is always good to have a refresher on tax contribution and deadlines to help ensure you are planning correctly throughout the year. An article in Investopedia titled "Retirement Plan Tax Prep Checklist" explains it all.
That's right, and we'll review the deadlines that you need to remember and remind you not to forget your required minimum distributions. The first date to circle on your calendar is the contribution deadline.
If you contribute to an IRA or Roth IRA, you have until the tax filing deadline to make contributions. After that, you don't get more time to make contributions, even if you get a filing extension.
That's right, and the rules are slightly different for business owners. You can contribute to a qualified plan up to the extended due date. Now, for this deadline, for this year, it's October 15th, according to Smart Asset.
You also have the option to set up and fund a SEP IRA by the extended due date.
Now, next, let's talk about using tax refunds for contributions. If the government owes you a tax refund, you may be able to apply that payment to an IRA or a Roth IRA.
If you submit your tax return in time for the IRS to send the funds to your trustee, you can use your tax refund as a contribution for the current tax year.
So how do you do that, Logan?
Great question, Cole. Use Form 8888 to tell the IRS where to direct your refund. If for some reason the funds don't arrive on time or you don't let the trustee know that you want to apply the funds to the current tax year, it is possible to apply them to the following year.
Now, let's talk about fixing excess contributions. In 2024, the IRA contribution limit is $7,000 or $8,000 if you're 50 or older.
If you make contributions above those limits, you may be subject to a 6% penalty each year until you correct that error.
Now, if you find yourself in this situation, don't procrastinate. Fix that problem as soon as possible. If you notice the mistake before you file your return, withdraw the excess contribution along with any earnings before the filing deadline.
If you have already filed and are still within the 6-month window, withdraw the excess contribution and file an extended return.
Now, if you're past the extended deadline, withdraw the excess contribution and then reduce next year's contributions by that amount.
Remember that any earnings you take out of your IRA will be taxed as ordinary income, which means you may have to pay a 10% penalty for early withdrawal if you're under the age of 59 and a half.
So let's talk about the opposite of excess contributions, required minimum distributions, or RMDs.
RMDs are the opposite of excess contributions?
Well, an excess contribution is when you put too much in. An RMD is the smallest amount that you have to take out. Sounds like opposites to me.
Well, I guess that's logical. So what happens if you miss an RMD?
Well, the IRS is going to impose a 25% penalty on any RMDs that you miss.
That penalty is equal to a quarter of the amount you should have taken out. That may be a pretty big number, so it's important to remember your RMD deadlines.
So what are those RMD deadlines again, Logan?
Well, you need to start taking RMDs by April 1st after you turn 73.
Now, that's for people who were born from 1951 to 1959.
That's right. If you were born in 1960 or later, then you'll need to start taking RMDs at age 75.
So how can our viewers find out what their RMD amount is?
They can check out the IRS tables, which are in IRS publication 590B. If your spouse is more than 10 years younger than you and they are the beneficiary on the account, use the table 2, joint life and last survivor expectancy. If none of those things apply to you, use table 3, uniform lifetime.
So what about inherited benefits from qualified retirement plans or IRAs?
It depends on your relationship with the person who held that account. Surviving spouses can roll over the benefits to their own accounts.
Easy peasy, right?
That's right. If you're not a surviving spouse, the rules stipulate that you need to take a distribution for the whole balance by the end of the 10th year after the account owner's passing.
So are there exceptions to that 10-year rule?
Yes. If the account owner passed the account to a minor child or a beneficiary who is disabled or chronically ill, exceptions apply. They also apply to any beneficiary who is not more than 10 years younger than the account owner.
Now, if you forget to take RMDs, relief may be available, but you'll have to show a reasonable cause for failing to take the RMD. File Form 5329 explaining why you failed to take the RMD, and include that form with your tax return.
What kinds of explanations does the IRS accept?
Well, the IRS may accept your explanation if you were dealing with a very serious medical condition or received the wrong advice on how much you should withdraw.
Are there other situations in which you may need to file a Form 5329?
Well, Investopedia covered this in an article titled Form 5329, Additional Taxes on Qualified Plans and Other Tax-Favored Accounts. And it says that this form may be necessary if you made excess contributions to a health savings account or HSA, or if you made excess contributions to an education savings account. You may also need to file this form if you received taxable distributions from an education savings account.
Back to RMDs. When you file the form, you'll have to show you took the RMD as soon as you were able to do so.
Okay, so what do you do if you took distributions before age 59 and a half?
You'll have to pay a penalty of 10% unless you qualify for an exception.
Now, this list is pretty long, but let's go over a few of them.
Of course. On the IRS's website, you'll see a page titled Retirement Topics, Exceptions to Tax on Early Distributions. It contains a table showing each exception and which types of plans qualify.
Now, if you've given birth to or adopted a child, you may be able to withdraw up to $5,000 per child to cover qualified expenses.
If you're the account owner and become permanently disabled, you may be able to take early withdrawals without penalty.
So what happens if a natural disaster strikes?
Well, if you sustain an economic loss due to federally declared disasters, you may be able to withdraw up to $22,000 without penalty.
And if you're the victim of domestic violence, you can take up to the lesser of $10,000 or 50% of the account. If you're a qualified military reservist and you're called to active duty, you may be eligible. If you're terminally ill, you may qualify as well.
Those are just a few of the examples of exceptions to the rule.
Now, we don't have time to go through all of them, but it may be a good idea to visit the IRS website to see whether you qualify for an exception.
This is all pretty complicated, isn't it, Cole?
It definitely can be complicated, Logan, and that's why it can be beneficial to work with a financial services professional who can help you sort through it all and decide when to take distributions and what you should do if you put too much money into an account or wait too long to take money out of one.
If you have questions about your contributions or your RMDs, contact our office today at retirewithbuska.com or call 715-355-4445. We'll be right back with more Financially Speaking after this.
You've worked hard to save money for retirement, but wouldn't you rather thrive and not just survive your golden years? My newly released book, Golden Rules of Finance for the Golden Years, offers key tips for managing your retirement money and ensuring you have a more complete plan to make your retirement dream a reality. Call 715-355-4445 or visit buskabook.com to request your complimentary copy today. Close your eyes and picture retirement for a moment. What does your dream look like? Would your days be filled spending time with family and friends? Maybe you desire to volunteer or work a rewarding part-time job. Or do you envision traveling the world? Whatever your dream consists of, Buska Retirement Solutions can help you realize it. Call or go online to schedule a complimentary consultation today.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. Now, this is the same way that we communicate to our clients when we meet with them in person. And remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time to get a second opinion on your retirement plan. So give us a call at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on some previous episodes of our TV or radio show, or to schedule that complimentary, no-obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and same place for another episode of Financially Speaking.